Ryan and not Dr. Ryan. So did anything change or
I still have the title. I still have a
I,
PhD. I haven't relinquished it. So, but Ryan is fine.
okay, تمام. Awesome. بالعكس, I think you're taking the title to another level. What did you do your PhD in actually?
Applied mathematics.
Okay, awesome. So super relevant. Uh,
Yeah,
not a career switch on the contrary. Good, good. So let's get started. Hi, everyone. Really excited for this webinar. It's a very special one. It's a very timely webinar on gold in 2025. We're gonna go and really dissect this topic that I feel like a lot of us have been hearing bite-sized parts about gold, whether it's on social media, in social settings, and you know, we've seen in September on Sarwa gold rise from the number eighth spot in August to the second most traded ETF on in September. So we've seen a huge surge in gold trading. As when I say gold, I'm talking about GLD, so physically backed ETFs, not nothing synthetic. Like one of the easiest ways to buy gold. There are many ways, whether it's the physical part, the ETF side, but what we really wanted to do here is to really zoom out and understand what's really driving this. What do we know about the future? What is the broader context of gold, its role in a portfolio? And I invited Ryan and Dr. Ryan Lama. For those that don't know him, he's been one of the most vocal and consistent, a great mentor of mine as well on building Sarwa.
thank you.
So it's really an honor to have you and to go into this topic with you because not a lot of people are into gold actually. A lot of people have aligned themselves with stocks, value-based investing, crypto, and are very vocal in what we can call maybe sexier topics. But gold has been probably now it's having its moment for sure. But it's as soon as I saw the surge, I thought of you because I always love to see the trust built from someone hammering a message across cycles, across many years. So I'll pause there as an intro, and I'd love to hear from you, Ryan. I have a few questions
Sure.
prepared, but first of all, kind of just a bit about your background and your journey to adopt gold as, an asset and a story, because that's quite an unusual one. Would love to hear the how you came to that position.
Well, first of all, Mark, thank you very much for having me here. I'm very proud of you, Sarwa, the whole team. You've done a fantastic job, and I'm really honored to be here again 1 year later to participate to this podcast. So my story, my professional story, has defined my views about gold today.
Mhm.
Um, I'm much younger than I look, or what am I going to say? So my first shock was year 2000 with the internet bubble. I was very, very, very young. I hadn't even started my formal university studies yet.
Mhm.
And that was the first shock because I really believed in the internet and specifically a company called Cisco, which was the only one manufacturing routers. So imagine they invented the internet and there was only one company doing routers, one called Cisco. So I bet everything on this company, like many others, and lost everything on it.
Mhm. Mhm.
That was my first shock. But that was not defining. What was defining came years later when I used to be the head of portfolio management in a very large European institution managing credit derivatives, credit default swaps, CDOs, etc. So these products are based on leverage, okay?
Mhm.
Where we use a lot of leverage to generate return. Back then spreads were very tight, and the only way to generate return was to leverage up, okay? And I'm a mathematician. It was all based on mathematics, very tight calculations, correlations, dynamic correlations, etc. And I really thought, like many others like me, that this was invincible because it's based on math.
Mhm.
However, what happened in the US in summer 2007 and what followed in 2008 showed otherwise, that this whole system can collapse. And the funny thing, I remember I was driving my car, I was back home in Paris,
Mhm.
driving my car, looking at the people walking in the streets, happy, smiling. They didn't know what was about to happen in 2008. I knew blood will be in the streets, unemployment. It would be dramatic. And it actually happened. Lehman blew up, and it was absolutely a disaster. And then the crisis moved eastwards, came to Dubai, and we all know what happened there, and many other countries.
Hmm.
And this is when I realized that yes, the system is very, very fragile, very fragile.
Hmm.
What happened afterwards was the invention of quantitative easing. So, what is quantitative easing? Quantitative easing is basically what was done partly in Lebanon with Riyad Salemi, which is the financial engineering whereby you artificially create money. Okay, many central banks do that. Now, when it's done in a controlled way, it's a good thing. It can help generate growth. But when it's done in a completely unlimited way, your M2, your monetary base, goes through the roof, and then the growth of your debt and your money supply, the rate of it exceeds your economic rate of growth. Why do we take debt usually, whether as households or companies or governments? It's basically to generate economic growth.
We
But when
believe the
our when
future
my
is
economic
brighter. Yeah.
yeah, so when my economic growth is 4%, but my debt growth is 6% or 10%, there's a problem there. Because my debt growth should be lower than the economic growth. It should participate to my economic growth, not increase my liabilities. And this is basically what happened. And this is when I realized that the $100 that we're holding in our hands, this paper, it's a very thin paper. How much is $100 actually to manufacture? It's nothing. It's a fraction of a cent, right? Um, but why is it worth $100? It's because it's issued by a country that has the strongest economy in the world. But is it really the strongest economy in the world? With $38 trillion, when we spoke last year, the US had $35 trillion of debt. Now it has $38 trillion of debt.
Hmm.
And there's no way to reverse that. So this is when I realized that this small piece of paper called $100 maybe is not really worth $100, and maybe I should invest into something that is worth what it is. And the only commodity that is worth what it is on Earth, it's
Hmm.
gold. It's not diamonds. It's nothing. There's only gold. So I started investing in gold when it was at $800. I
Hmm.
actually invested into three things, three commodities. Man,
Okay.
I'm a professional trader. I
Hmm.
invest into real estate to live and for my parents. So real estate, but not on a wide scale. Uh, I didn't want to use debt, obviously, because when my debt increases way than more than my ROI, there's a problem. So it was under control. Second, it's gold, and three, it's rare art. These are
Hmm.
the three things I invested in. And obviously, I had my liquid portfolio with stocks and bonds for retirement, etc. So gold, I didn't expect it to do that well, and it actually did. So this is my story with gold. That's how it started.
That's awesome. So it sounds like it's very rooted in something not a lot of people, or something sometimes people forget, where it doesn't go always up and to the right. It's rooted in experience, cycles, pain. I imagine lived from seeing what seems, you mentioned Lebanon as a collapse. Like these are scenarios that are once in a lifetime, or can cause a lot of damage. So it's an understanding around that, and wanting something much more robust that can withstand shocks. And it's seen a lot as, you think safe haven, you see gold, and there's a lot to unpack from what you said, but I want to touch upon, one of the biggest critics, let's say, of gold is people like, Warren Buffett, that will poke at gold, will say, it doesn't produce dividends, it doesn't employ people, it doesn't, and I'm sure you've heard these reservations. Um, One thing that maybe surprised me is that there's always uncertainty in the markets, and I'm curious, what do you think is driving the surge now? Because when I read, for example, Warren Buffett's letters, the theme around debt, the US's debt is an old one. The amount of debt, there's always been debt in the system. There's always been credit. It's something that's quite um, in line with how the US operates, or the US economy, or global market. So I'm curious, what is it about today or in 2025 that is driving this surge? What changed so that it's maybe no longer just a safe haven, it's starting to have a bit more, I want to say, growth into it, where we're starting to see double-digit numbers. So,
100%.
you phrased it as, when I get that it's the same role as a real estate or something that's more tangible, let's say. But do you think it has, I guess the two questions I'm asking is what's happening now that's taking it to another level? And does it have another role to play in your view beyond doing well when um, things go wrong?
Okay, there were three events that pushed gold that fast up. So it obviously we had Bretton Woods when the gold standard was abandoned, whereby you couldn't anymore use dollars to exchange it against gold in the United States. Now, the first jump in gold happened post 2008. Okay,
Yeah.
the second jump happened around the pandemic. Okay,
Yeah.
before the pandemic, actually, after when the Ukraine-Russian war started, when the US dollar was actually weaponized. So this is when you couldn't use SWIFT anymore if
Mhm.
you are a sanctioned country.
Yeah.
You could get sanctioned and your money could be frozen.
Yeah.
So many Russian oligarchs, even though they had nothing to do with the system, they had their assets frozen. So this is when people realize that yes, the number one reserve currency in the world, the US dollar, which is used in exchanges, 90% of exchanges around the world happen in US dollar, is not reliable anymore. We need another alternative. And the second,
Sorry to interrupt you, but when you say we, you're talking about the countries that are not as allies to the US, or for example, competitors, whether it's you're talking about the emerging markets or you're talking about more generally any non-US country.
any non-US country, but particularly I was coming to that, the BRICS countries, obviously
Yeah.
this was driven. So the third was the BRICS countries. So
Mhm.
this is where a disconnect happened between East and West, whereby BRICS countries realized, okay, so we're buying US treasuries. So China was one of the biggest buyers of US treasuries, right? Um, and many other countries used to buy US treasuries. They realized, okay, so we're buying US treasuries. Is this safe? Should we diversify our central bank reserves? And this is where we had this big jump. So the first jump went from $800 to $2,000. $2,000, we hit it in 2020. Then we had a sideways horizontal move from 2020 to 23. And 23 onwards, it went up straight line to 4,000. Now, let me give some numbers.
Mhm.
Gold is obviously extracted from underground through mines. Okay, then it comes in a very raw form. It's actually quite flexible. It's not very hard when
Mhm.
it's pure. Then it's manufactured into jewelry, into coins, into bars, etc. So the total gold that is estimated on planet Earth that is in our hands, not in mines, is 220,000 tons. This is how much we have gold.
Mhm.
The annual average of new gold refined each year is 3,000 tons. It's not much, okay? We can't do more than that. So there are many big refiners around the world, Germany, Switzerland, many other countries, China. That's how much we can extract, manufacture, and put on the market. It's 3,000 tons each year.
Mhm.
Now, before 2020, these 3,000 tons were actually bought as jewelry. They were bought as investments in small bars by some investors. And they were bought by some gold ETFs, 3,000. What changed this whole thing post 2023 was that central banks started buying from 22 actually started buying each year 1,000 tons of gold.
Mhm.
So out of the 3,000 that were satisfying market demand, 1,000 now went to central banks. So the third. So obviously demand was much, much, much higher than supply, and this is what has driven the price of gold to 4,000. This was the radical change that happened. Central banks today, if you look at central bank balance sheets in multiple countries, now they hold more gold than US treasuries. And this is what they wanted to do. And they want to increase it more. So if you go to the World Council, the word gold council, sorry. So this is the authority of gold internationally. You see their statistics. They've done recently a poll among world central banks. 75% of the world central banks have said they will be buying gold over the next 3 years. 75%, which means demand for gold will continue by these central banks because they want to diversify away from the US dollar. Now, why is this accelerating? Let me give you some more numbers. So the United States today has $38 trillion of debt. Each single day, the debt in the US increases by $25 billion. The US pays each day $2.7 billion of interest.
Hmm.
These numbers are staggering, okay? The only way to reverse that, there's no other way to reverse that. It's austerity. And the US cannot afford austerity today because this will put it into a very deep recession. Um, So this is where we are. People or investors, central banks have realized, well, this is not reversible. So as long as the US law, the United States is able to issue debt, people buy treasuries and recycle it, everyone is happy. It's fine. But when the music stops and people stop, or not stop, but reduce their buying of treasuries, then the US has a problem. And
Yeah.
we've seen a few US treasuries auctions actually not succeed very well lately.
Yeah, no, I love that part because again, it's taking such a long-term view about things, and there's a lot we can learn from history, although it doesn't repeat. There's a lot of lessons to, especially for a lot of new investors, which there's a ton of, especially for Sarwa clients, millennials, Gen Z, 80% of them are in these buckets. So to to understand what happened and how things behave, I want to ask like one of the questions. I know you're getting quite a bit in your comments on LinkedIn where you have incredible content, and we have one from Michael here that he's asking, what is the parallel? Are we seeing a parallel between gold prices and the AI boom, similar to the what you lived with Cisco and the dot-com area? And I imagine that since you started investing in gold so early and you've held on to that strategy, you must have done a lot of mental work not to fall into like a doom and gloom, or you know what I mean? I think some investors are almost victim of their own intelligence, where they start to see a certain pattern that isn't there and that hasn't played out. So I'd be curious, kind of, what are your views on that? And I can share a bit about mine, and maybe you can we can debate it a bit. But I feel I've learned that it's important to position yourself regardless of what happens. So it's not about being right as opposed to covering a broad range of scenarios. So I wanted to see, um, I'd love to hear your comments a bit about putting this in context with previous. What are some narrative? What are some things that can support a narrative that there's a similarity, for example, with the tech bubble? Uh, and and in terms of sizing, I'd love to hear your point of view from your research, or even how you go about running your investments. What kind of sizing are we talking about? Because the closest one I found is, talking about 15 to 20% of gold can hedge 100% of a equities portfolio. But there's varying research and mathematics on it. So um, yeah, would be great to get into these.
So I can give you my personal portfolio, personal. I have 25% of gold.
Hmm.
Okay. Then I have 40% of Swiss equities for quite some time now. And the rest various pockets. This is my personal portfolio that will go to my
Double digit,
children.
strong position in
Yes,
gold.
yes. Year to date, year to date, I'm in excess of 20% up, and I'm very uncomfortable with it because this portfolio is not built to generate that much return. I do not want it to generate that much return because
Yeah.
obviously the more return, the more risk you have. Okay.
Yeah.
Um, so our model portfolio at the company, it's 12, roughly 20% gold.
Mhm.
The rest, it's a combination of Chinese equities, Indian equities, Swiss equities, some GCC, small pockets of GCC equities, stock-picked European equities, mainly in defense and a few others. So we steered a bit away from the US and around that AI craze. Because we're traditional investors. Okay, we
Yeah.
we don't follow hype. Okay, we don't invest based on hype. We're much more traditional. I'm much more traditional as an investor. Now, regarding the AI and its parallel with the internet bubble, um, there are similarities. Right? It's undeniable. There are similarities, but I don't think they are the same.
Mm,
Back then with the internet bubble, companies were less profitable than the companies we're seeing today. Okay, this is a positive. So many of the companies that we're seeing today, like Nvidia, they're very profitable. By the way,
mhm,
Cisco in 2000 was very profitable as well.
mhm,
It wasn't unprofitable. So this is where it's encouraging, whereby this rise in stock prices we're seeing in the Mac 7 or in the tech stocks is not really driven by multiples. It's really driven by actual revenue generation. Now let me tell you what I do not like. There are two things I do not like. One is that these companies are investing into each other in a circular manner. So you
mhm,
see NVIDIA investing into OpenAI, OpenAI investing into Oracle, and then Oracle investing into NVIDIA. So this, pardon me the language, incestuous
mhm,
investment happening among them is very risky. It's
mhm,
it's bidding up, it's creating headlines, and this is drawing investors in. It's a perfect circle happening with these investments happening. The second thing I do not like is the potential, and we're starting to see a lot of talk about it, is the potential over investment into data centers. This is bound to happen. And I
yeah.
can give you two parallels. The first one happened in the 19th century in the United States, 1800, the year 1800, when trains became a big trend. Okay, there were no planes obviously back then, so the only way to travel cross country was trains. Lots of investments poured in the United States to build tracks for trains. So what happened was huge overinvestment, and if you read about it, they were like the whole market collapsed on the back of this. The second parallel I want to draw happened before year 2000. So there were a few companies. This is when the internet was starting to build. They built huge infrastructure for fiber optics. Obviously, all of it collapsed, and well, it's gone. Okay, so multiple company people can read about it. Many companies collapse. So it's not only AOL and Yahoo and that collapsed. It's the whole fiber optic industry that collapsed because it wasn't needed anymore. So what's happening today, I feel it's a bit similar
Mhm,
in the overinvestment drive that is happening because there are limitations. There isn't enough energy. So this is where China is ahead of the US. All of these data centers, they consume massive amounts of energy. So
mhm.
when you type, you go on ChatGPT, you ask it a question, it consumes 15 to 20 more energy, 20 times more energy than you asking the question to Google, making a search on Google. That's the scale, okay? So this is what worries me about all of this. Okay, I'm not against it. Part of my PhD was neural networks, so I worked on what is AI today 20 years ago. I believe in it, but I think the hype got too much, and it
Mhm,
has to slow down a bit and become much more realistic. The last number I'm going to give you, and I think you talked about it as well, 93% of companies working in AI are failing at the moment.
mhm,
93%. Okay? So this is not negligible. And these are similar trends to new technologies. They happen all the time. AOL, America Online, was the leading internet company in the US. Where is it today? It's gone. So I do
mhm.
believe everything we're seeing today will change. We'll have other companies better built, slower, more better footing. So that's why I'm a bit careful into driving myself into the current hype.
I love it. I know I love the balanced take because it's, you articulate really well what you're monitoring to see it change and that concentration amongst these players. As soon as we start to see a bit less of that, that continued profitability, these are all elements to monitor, and that can, along with the debt that you mentioned, can leave someone worried. I want to call out a comment from Hamad Sukri, who echoed a lot of kind of some of the macro as well, and President Trump's tariff policy that have also been a strong rally, and a lot of that uncertainty caused by just a tweet sometimes also raised a lot of eyebrows. And he mentions Ray Dalio that is one of the prominent also figures that's been hammering the point about hedging. And he said he mentioned 10 to 15% of gold as an insurance sleeve. I love these numbers because, especially seeing the Sarwa data that I look at daily, we're seeing an improvement in hedging, but nowhere near the high double digits, I would say. So for anyone listening, and I know your exposure pretty well into equities, global equities, US equities. It's hopefully this is a refreshing take where you're hearing about quite strong hedges, quite strong allocations into safe havens rather than just putting a couple of $100 here and there. So and that's why we're doing this webinar, is to take that allocation view the same way professionals allocate. A lot of you are in charge of your own allocation. So these are the kind of figures we're seeing when people are serious about gold. Ryan, I want to jump into something because let's say I joined this webinar halfway in. I might think that we're talking about Bitcoin. So and then a lot of the language, or at least Bitcoiners, when you meet them, there's so much overlap. The first kind of poster they're gonna throw at you is the US debt. The language even that you are using is quite similar in terms of what Bitcoiners, what brought them into Bitcoin in the first place. These are common themes. So I'd love to hear, and I know we discussed Bitcoin as something you've changed your mind on last time, but I'd love to hear, is it overdone as a comparison to gold and Bitcoin? Of course, I feel like gold has this advantage of having so much more as a historical context and that track record. But I'd be curious where they overlap and where they're different, because depending on the week, I sometimes Bitcoin is the narrative is around the hedge, but really I feel like it's leveraged S&P. So curious what you think around someone that is maybe has some Bitcoin and feels like, oh, I'm already covered, or no, not at all. Like Bitcoin is playing a different game, and you need to be looking at gold.
The driver behind Bitcoin is the same driver behind gold, which is using an alternative method of storing value. This is
Mm-hmm.
what I believe. The Bitcoin enthusiasts wanted to steer away from fiat for the same reasons I just mentioned,
Mm-hmm.
which is high debt in the US, the system that is very fragile. And this was very obvious in 2008. The system is very fragile. It's funny because many people, um, so after the Lebanese crash, when I explained to them the fractional banking system, they wouldn't believe their ears.
Mm-hmm.
People do not conceive that if you put $100 at the bank today, only $20 are sitting in the bank and $80 have been lent to someone else.
Yeah,
So now if we all go to the bank and ask for our money is not there.
yeah.
Many people don't know that the fractional banking system that the whole world adopts is based on leverage, basically, whereby our money is not at the bank.
Mm-hmm.
So people started believing less in the system when 2008 opened their eyes. And this is, again, a very similar timing to gold. Bitcoin and virtual assets took off.
Mm-hmm.
Now, gold remained very basic. It's just an investment. You buy or you sell, you store or you use an ETF to buy it. Virtual assets and Bitcoin became much more complex. This is when we created a whole financial system around it, decentralized finance, what is called DeFi, right? So it became much more complex than gold. And this is where things became a bit risky, in my opinion, where you started having these various types of coins with different uses. And many of them, people lost a lot of money, like um, uh, so I'm not going to name any coins, but many people lost a lot of money on these coins.
Mm-hmm.
The one that stands out, as you mentioned, is Bitcoin. Okay,
Mm-hmm.
so Bitcoin, um, it's a computer program. We have to realize it is a computer program. It's based on a cryptogram. And that cryptogram, people can fact check me now online. This cryptogram is based on a cryptogram created by the NSA in the United States in 1995. Okay, so I'm just putting it out there. I'm not implying anything. I'm not a conspiracy theorist. But it is a computer program based on a cryptogram. If someone breaks that cryptogram, well, what happens to your money?
Mm-hmm.
Gold, the same thing. If I have a safe at a bank and someone breaks into that safe and takes away the gold, my gold is gone. The same thing if I have cold wallet, someone steals the cold wallet, well, my Bitcoins are gone. So this is the similarities between the two. Okay. If you give me the choice, definitely gold because I understand it better, and there isn't that technological element in it. It
Yeah.
I want to reduce my risk as much as possible, and the more I add components to it, the more my risk is increasing. Right? Gold is physical. I can put it at a bank, insure it, close on it. If it gets stolen, it costs me peanuts to insure it, by the way. So even if they break in into and they steal my gold in the bank, in my safe, I get compensated. Okay. With Bitcoin, I don't have that luxury. Do
Hmm.
I own Bitcoin? I do own Bitcoin. Absolutely, yes. In very small proportions. For me, it's sort of an experiment rather than an investment. It's something I'm checking and I'm looking at. So I'll just lay it out there. I'm with both, but my preference is to gold.
I love it. No, I love that you also communicated the preference, which role it plays in your view, because a lot of the times everything gets put on the same comparison. You're comparing gold to Bitcoin to equities when the objective and of each investor is so different. Clearly, from talking to you, you're not someone that values consistent, incredible returns because if anything, it's going to give you a signal that there's a huge amount of risk underneath it. What you're optimizing for is a lot more around getting there in a steady way. If there is such a collapse, you don't feel like you completely were overexposed or missed a very important driver. So it's also important to understand the the objective of the portfolio. And there's nothing wrong with, again, jumping on the AI hype as long as you know the risks behind it. So on in that same vein, we talked about hype, we talked about the context of where we are today. Um, what would make you start to be maybe uncomfortable around, gold becoming, it's already at an all-time high. Do you worry about a gold bubble? Do you worry about, all the recent inflows going into gold, whether through coins or through ETFs? Is there a certain limit where, in your point of view, it makes sense to trim, to maintain, or to adjust gold? Because given it's a safe haven, you could argue there's no need to rebalance. So I'm curious, what's your view around its price level? Or obviously we cannot predict the future, but just in general, how you're planning on adapting if it reaches new levels, and at which point does it become too much?
Okay, so my main indicator here is central bank buying.
Mhm.
When central banks stop buying, I will know that the supply and demand will balance out. We'll be back to the balanced supply and demand. As we know, oil, we've seen it go to $140, right? When did this happen? When demand was much higher than supply. It's basic economics. It's economics 101. Gold, it's the same thing. The factor that changed things is central banks intervening and buying 1,000 tons a month. Okay. Sorry, a year. So this is what basically changed that component. Central banks buying is here to stay because they will hold, they will not sell, in my opinion. The reason behind it is that many central banks around the world made mistakes by selling oil. So if you look at the Bank of England, they sold gold in the 80s for 300 pounds.
Mhm.
300 pounds. So imagine how much they lost, the opportunity costs of selling gold. Many countries held on to their gold, kept it, and today, yes, they're doing very well. So the United States, for example, just to give you a small number, the United States today, all of the gold it holds, I think it's around 8,000 tons, if I'm not mistaken, it's valued at $42. They haven't even adjusted the price to the current price of gold. So imagine the US balance sheet, how it would change, even though they're not going to sell it, how much it would change if they factor in the current price of gold. So my trigger, my first trigger is central banks stopping their purchases on a monthly basis because they are buying on a monthly basis at the moment. That would be my trigger. Would I sell? No, I wouldn't sell. That's something I would keep because that's something, it's a legacy I will give to my children and hopefully it will stay in the family. It's a protection, it's a safety net.
Mhm.
And let me tell you one thing. For me, gold is not an investment. Gold is two things. Gold is a hedge, and gold is a saving. So instead of putting my money in a savings account at whatever, 4, 3, 4%, no, I prefer to buy gold.
Mhm.
I feel much safer holding gold than putting my money in a savings account where my
Or-
money is being used to be
Mhm.
lent to someone so he can buy his flat or buy a Ferrari or whatever, or lend it to a company that might fail. Okay? So for me, gold is two things, hedge and savings. That's it. I wouldn't reduce it. I do believe gold will reach the point where it starts wobbling horizontally, just exactly as it did in 2020, between 2020 and 23. I think we reached that point. Could it go back to 3,500? Yes, I wouldn't be surprised. Because if central banks stop buying today, this might trigger a few to book their profits, and they would be very entitled to book their profits. And yeah, this is when we might have a bigger correction on gold and could go to 3,500. I wouldn't be surprised about that.
Yeah. That's great. I think you touched on something I wanted to ask you around what are some of the common mistakes people make on when it comes to gold, and I think it's seeing it as an investment.
Yeah.
Might be one of them. So I'd be curious, what are the things amongst all the content and dialogue around gold that you feel like people are missing or they're not understanding about it, and anything else that that stands out to you or makes you want to be like, I need to write about this. Let me grab my phone and type away on LinkedIn.
I was actually on an interview today on Sky News where I talked about it. So since that correction, we've seen 7, 8%.
Mhm.
My phone hasn't stopped ringing. Should I sell? Should I sell? Gold is not a stock. It's not
Yeah,
Nvidia stock.
yeah.
Okay, you don't buy it and find an opportunity to sell it. Gold, it's like the apartment you buy to live in. That's how gold should be perceived. It's home. It should give you the home feeling. It's your safety net. It's your protection. It's if, again, I'm not a conspiracy theorist, but if this whole world collapses, it's the thing you use you're gonna to buy food, maybe if something bad happens, right?
Mhm.
We had a massive pandemic where the whole world closed down. We could go out and not find an open supermarket, right? Some countries lived very difficult times. No one would have conceived this could happen one day. Okay,
Mhm.
we could have a massive hurricane, flood, whatever, where we could not withdraw money from the ATM machine. It's a
Mhm.
gold coin that will help you. So it's your safety net. It's not an investment. It's not a tactical investment. It's not something you play or you speculate on. And this is what people need to understand. No, if price moves, it doesn't mean you should sell.
It's one of the best and worst thing about technology that I've come to learn at Sarwa, which is we've made access
Yeah.
so easy that it's incredible around how, getting ownership, increasing ownership, but in the same vein, that sell button is just as available to really make you rethink the whole strategy. So I think that's where a lot of these sessions play a role to position, I guess, to help people think through when do you act, and that's why we're getting great questions on at which point, how would you behave in this scenario, and just running a few scenario analysis so you prepared before they arrive. So it sounds like one thing you monitor closely is the central buying activity and that supply and demand threshold. When it starts to cool off, I guess that would imply that geopolitical tensions are cooling off, US-China relations are becoming friendlier, and then gold's role will cool off a bit from seeing that. So
Yeah.
that's what we can expect, a potential drop to continue if this improves. But it's already high, it's had such a strong run up. Then when we focus on a 6% dip, it's funny when after how much it's increased by as well.
Yeah, you just look at the graph. Look at the graph. It's like a small, tiny dip. It's absolutely nothing. Now, quite a few banks are forecasting $5,000 simply on the back of they believe that there will not be a détente between the US and China. Um, so China, and again, I've wrote multiple times on it on LinkedIn. China is looking to have the renminbi used as a settlement currency, as a reserve currency.
Mhm.
Okay, and it already started with BHP with Australia, whereby they don't accept US dollars anymore. Australia has to pay in renminbi. This is quite substantial, not in amount, but as a milestone.
Mhm.
Okay. Today, some oil being sold to India through India settled in UAE dirhams. Okay, so the monopoly of the US dollar as the international settlements currency is changing. Okay, um, and this is not really easily reversible. And that's why many banks are betting that this will continue, the clash will continue, this international clash will continue, that China will continue moving in its direction, in the direction it wants to move. And hence, yes, it needs to buy gold to support the renminbi to say, yes, I have a debt to GDP of 93%. The US has 130% debt to GDP. I'm reassuring you by buying gold to support my currency. This is the Chinese story, I think, today.
Yeah, yeah, highlighting its strength and financial discipline as well, alongside its growth as well. It's super interesting. I wanna. There's a lot of questions that are really good. I wanna first, well, thank you, Ryan, but also the engagement that is uh, really great at making my role as a host much easier. So I'd love to ask just if we can do cover a bit of questions. One of them is around something you mentioned earlier, which slipped, but it's true that it warrants a bit of a double click around what's your rationale on Swiss equities? I know the Swiss are known to for a lot of that decentralization, the way they run their country, and would be curious what made you choose that and as an allocation.
So Switzerland has always been so Switzerland compared to gold. So if you look
Mhm,
at the world map, Switzerland is gold as a country.
mhm,
It has managed to preserve its neutrality, its borders, its everything, whether during the First World War, Second World War, economic crises, financial crisis, you name it, it remained very, very stable. That's one. Two, all world leaders, all of them, the good, the bad, the ugly, the corrupt, they all have their money in Switzerland.
mhm,
So there's a huge intersection of planet Earth and maybe some aliens as well to keep Switzerland a very stable country.
mhm,
It's the place where we put our money, okay? It's the bank. Okay. Um, the three, you have these fantastic companies that just people keep buying. Are we going to stop eating chocolate? No. Nestle is there. Are
mhm,
we going to stop buying medicine? No. Roche is there. And there are
mhm,
multiple companies like that in Switzerland where, you know what? Whatever happens, we will continue buying their products. They're very stable. They don't have debt. They pay dividends. So it's really, if you would like to have a very boring portfolio that pays you on a regular basis, that doesn't keep you up at night, it's Swiss equities. And that's what I love about it. I'm
yeah.
not building a portfolio to go buy a house in Monaco or drive a Ferrari. I'm building a portfolio to ensure a legacy for my family, so my family can live better than I lived. As simply as that. And to do that, I have to provide a safe and stable portfolio for that because I'm not sure my children will be as good as me in managing portfolio. They might go buy Nvidia.
I love it. I love it. And I love how much it contrasts to, maybe it won't, the kind of AI heavy portfolio gives you a lot of bragging rights recently, but the peace of mind that comes from this in diversification and value investing
Yeah,
is
let's tell you one thing, Mark, a quick anecdote. So in the peak of year 2000, there's a small company that nobody knows about called Microsoft. I bought its stock at the peak of year 2000.
Mhm.
You know how long it took for this position to go back to par? Because obviously it went down. It took 16 years for this to go back to par. So when
Yeah.
we invest in the stock market, it's generally to later on to please ourselves, buy something, right? So time is very important in stock markets, but sometimes time is not enough.
The entry
16
point
years
as
is a
well.
very
Yeah.
long time.
Yeah. You can have a great company, but if the entry point was
Yeah.
at a tough
Was
time,
bad. Yeah. Yeah.
it really matters. It's something I've learned as well. You can have a great company, but it's important at which point you're of the cycle you are. Um, this is a bit of a longer one, but let's get into it. So, a question from Hamad. Dr. Ryan, analysts like Jim Rickards have argued that structural debt levels, currency debasement, and central bank accumulation could eventually push gold toward $10,000 an ounce. Do you think that's realistic, or is gold's rally today being driven by completely different fundamentals? This assumes if global M1 supply around 50 trillion and global office gold holdings around 35,000 metric tons, then 50 trillion divided by 35,000 tons times 32,000 ounce a ton equals $10,000 per ounce. So,
Yes.
um, yeah, high level math to basically see the upside of gold. What do you think about that?
Well, if thank you very much for it's a very good question. If you go back to many of my interviews years ago, I've been predicting a price of $4,000 again based on calculations. We're there.
Mhm.
Um, Now the $10,000 is a bit far-fetched and assumes really a tail event that happens. That tail event could be a war between China and the US, an actual war, military war. It could be a US default on a technical default, not necessarily financial default, on one of its treasuries. So these are things that could push gold prices to very high levels temporarily or permanently. I don't know. But again, these are tail events.
Mhm.
I would not bet on them. I would not bet on them.
Yeah, it's more of a potential upside where you knock it off of the park type of
Yeah.
outcome, but that comes with a
But
big cost usually to society as well, as well.
oh yes, and if we go there, God help us all, because we might not find a place to sell that gold to have money to buy food if these scenarios happen.
Yeah, yeah. Um, a question from Michael. With gold prices going up, does that affect the strength of the dollar? And what do you think about Trump saying he wants a weaker dollar to make it easier to pay off debt?
That's a very, very good question. Thank you very much. So let's talk about currency pairs. Okay. When I want to buy Japanese US dollar pair, right? And I'm holding it, my position goes up. Okay. If either the Japanese yen goes up in value or the US dollar drops in value. This is for currency pairs. This is classical. Okay. This is foreign exchange 101. Now for gold, what is happening right now, it's not the price of gold that is going up, in my opinion. It's the US dollar that is dropping in value versus the gold. This is how I see it. So yes, uh, dollar is losing ground in value, in usage, in settlement, etc. It's because the US economy today, its metrics, and this is undeniable, are weaker. High debt, deficit, there's no manufacturing in the United States. Consumption is only done by the top 10%. Middle class and low income are not consuming. They're in a difficult position. So yes, the US economy is weaker. And this is why the US dollar is weaker versus gold. That's how I see it. President Trump wants a strong dollar, but yeah, he's working for a weaker dollar.
Yeah, yeah, there's just so many connected there's so much connectivity, right? And I know what you mean because I look at my Sarwa portfolio and you see a lot of great returns since 23 at least, but you also know that it's also being balanced with a weaker dollar. So there's a lot of forces to monitor. A question from George. Thanks for joining, George. And you beat me to it. That was going to be an off topic, but kind of related as well. So what's your take on silver as a long-term investment? Do you see it as redundant when someone already holds gold, or does it actually play a complementary role in a portfolio? And we're seeing that as well. Like silver is slowly rising in popularity as well. I think it made it to top eight in
Yep.
September when it was non-existent in August in our top traded. So would love your take on silver if it's an or an and to George's point, and what can we draw in terms of takeaways about it?
Very good question as well. It's an or, not an and, simply because silver has a usage. It's an industrial usage and it's being used in chips. So it's related to the AI trade. So if you
Mhm.
buy silver, you are to a certain extent correlated to the AI trade, but better off, in my opinion. I will add to it palladium and platinum. These three, silver, platinum, and palladium, these three are correlated with each other and linked to the technological usage of them. Actually started investing into silver 6, 7 months ago in relatively small amounts, and I'm building a position there. Uh, Again, on the back of all of the data centers that will be built that need silver to build the chips, to supply these data centers. So rather than invest into a data center, I'd rather invest into silver.
Okay, that's quite different actually there. That's much more of a growth
Yep,
speculative role it's
100%.
playing as much as when we're talking data centers, AI, there's no you're not seeing it as a safe haven
No,
or a second degree type of safe haven that sometimes
no,
people can think.
no.
Okay,
It's more speculative than actual safe haven. Yes.
super interesting. So that's more part of your like a growth allocation to be part
Yes.
of that, the
Yes.
underlying
Because
driving
yeah,
these.
because a data center can collapse, can potentially not generate enough return on investment, ROI, and just be shut down. But it
Yeah.
had already bought the silver needed for the chips to build that data center. So I would have already made my money rather than invest into the end product, which is the data center.
Mm-hmm. I guess it's is there it's similar to the gold can the jewelry play or another function that gold is playing. Silver is doing that, but with AI
Yeah.
or is it okay? Um, Great. Another question from Hamad. For those from Argentina, Zimbabwe, Turkey, Indonesia, etc., where currencies are now next to nothing, how would you advise from investors from these countries, um, all in commodities? So the question is around, for
Yeah. Yeah.
closer to home, like maybe Lebanon as well.
Yeah.
Um, does what would change for someone living or listening to this maybe, or with strong ties to a country that's overexposed to that currency collapse, etc. Does that allocation change? I think you answered it at least where the role it plays is much more around that savings and that
Absolutely.
reserve side, right? Don't
And
leave your savings in that currency.
yes.
Constantly swap out into gold and have the majority into that. And whenever you need to spend whatever you need to. But in terms of reserve, you see it as in gold.
And I'll say it's the same thing that I told Lebanese friends years ago. When the interest rates you're being offered is too good to be true, that means it's too good to be true. Stay away. Stay away.
Yeah,
It's just doesn't add up.
yeah.
So again, commodities, gold, even agricultural land is the answer.
I love to get specific. As for us, when you've studied or worked in finance, too good to be true is very obvious. I've learned one of the issues is that people don't know what that number is. So I'd love in your view, when does it become what are we talking about? Let's put some numbers behind what is too good to be true.
So too good to be true when interest rates become double digit, for example, when the interest on the US dollar is at best 5%,
Yeah.
then there's a problem here. So you get paid for the risk premium you're taking, or the risk premium or the risk you're taking on the country where you are, but it doesn't justify going up to double digits. When the banker is chasing you, wow, there's a question mark there.
Yeah.
Always doubt the banker who's chasing you.
A funny story, I graduated in 2014 in finance from McGill, and then I started working in finance. Well, I did a bit of consulting and then finance shortly after, but long story short, I was a bit disappointed because in uni, all the problems we were solving were a risk-free rate of 4 to 5%. But then when I'm getting a mortgage or we're talking savings, everything is zero, one,
Yep.
0 point something. And I was like, man, academia completely is, I thought it was outdated or my degree needed an upgrade. Turns out it was the opposite. It was trying to warn me we were in a very unique time when the risk-free rate is much closer to a 3, 4, 5 at best, at least historical averages. Great. Another question. This is a really interesting one, and I'd love to comment on it as well. So it's important to distinguish between exposure to gold in the physical form versus exposure via an ETF. And I don't think there's one catch-all for ETFs. I think we should also break that down into physically backed versus synthetic. In an
Yes.
apocalyptic scenario, Ryan describes an ETF would not buy food. And I think the similar logic applies sometimes when people talk about Bitcoin. And I would love to hear generally your views around the different views about gold, whether it contradicts Sarwa or not. The point is to show the different options. And I'll add to the question as well, if you can comment maybe on the different types of ownership. So one thing that often comes about is like companies that are in the mining business,
Yeah.
or you know what I mean? So it'd be great to get an overview. Okay, let's say I understand the thesis, I'm bought in, I want to build up my gold exposure, and I have a variety of options. What do we know about the different avenues and the pros and cons of physically backed ETF, and maybe going the extra mile into companies that are in that business?
Yeah. Okay. So that's a very important question. I'm going to touch upon a problem that many are facing today. First of all, I always favor investing into physical gold. That's my preferred way. Okay. I control storage. I know where I'm putting it. Sometimes I go touch it. I like to see that it's there. It's a nice thing to see, right? So I always favor buying physical gold. Second, never go and buy a big quantity of gold. Gold is always bought because it's a saving. Remember, it's bought on a regular basis, monthly, quarterly, annually, the way you want, but don't just go and buy in one go, right? Imagine you're buying a car. It's not, you don't buy the whole car. You buy the first tire, the second tire, the third. You buy a car slowly and then you build it. Gold is the same thing. You should never go buy a big amount. It's always staggered over a period of time. So physical gold is my preferred one. My second preferred one is 100% backed physical gold ETFs. So ETFs you have from zero backed to 100% backed and everything in between. Some of them 50%, 20%. So if you really want to buy an ETF, buy 100% backed. This is my advice. The third one, and this is it's an or, okay? I wouldn't take it as an and, investing into gold miner companies. So gold mining companies today, they're celebrating. So they're four or five large companies around the world. They were very undervalued and now they're generating humongous profits. And now their stock price has caught up. But this is speculative, okay? Here we're not talking about gold anymore. We're talking about speculative investing. You're buying into the stock of a company, okay? Now, the last bit I'm going to mention, there are risks everywhere. Let me start with the first one. Physical gold. You will face the risk of buying forged gold, gold that is not really gold. And it's happening with a lot of people I know. So they buy a gold bar and it turns out to be only wrapped with gold. It's not actual solid gold. And they get a certificate with it. So even the certificate is wrong. People have to be very, very careful there. Big places where you buy gold, they have a machine. It's like a gun. They point it to the gold, and it can tell you the caliber of the gold. This then you will ensure that it's actual gold. Another way is you take a magnet with you. You approach it. If it pulls even just a little bit, that means it's not pure gold. It's not
Mm.
99.5% gold. That means there's something in it that is not gold because they have to put metal in it to make it solid, right? If it pulls even a little bit, but this is not a very reliable method. The best way is to go to refiners directly or supply or agencies that work with these refiners, big places with usually the bar has the name of the refiner, very detailed, it's very clear. Don't go just to the souk or some shop that you find and buy gold. There's a lot of fake gold going around at the moment. That's regarding physical gold. Regarding ETFs, there's always the risk of a financial crisis. So the issuer of this ETF can go bust. I mean, Lehman Brothers, if you told me Lehman Brothers, if you went back to 2005 and told me Lehman Brothers has collapsed, I would have laughed at you. I would have
Mm.
laughed at you. Lehman Brothers, it blew up. So in a financial crisis, any institution can blow up. So your risk is an extreme financial crisis that happens, like in 2008, and the issuer of the ETF blows up. Now, the good thing that it's 100% backed by gold. So you'll have to wait a few months and then you probably get your money back. But that's the risk. So these are the two types of investments into gold.
That's an amazing breakdown. And it's fun to learn about the physical side for someone that's very much into ETFs. It's nice to see how to hedge or go against that risk of counterfeit. And even on the ETF side, I think you kept it super simple. I don't see any reason why you wouldn't go for a 100% physically backed ETF. There's so many on them. It's so easy to find. Um, there's one we have actually a curated list of ones that are physically backed just to help people out on the app. So that's something you would have seen as well. And Ryan's point, it's really important to pick the right one and not take any or at least minimize counterparty risk as much as possible. Um, I have a question from Usama. I think we touched upon it, but I'll go into it really quickly just because we're up on time. Um, it seems that, we're talking about the economic system that's paper-based, further deteriorating, while those keeping the physical assets like gold, agricultural land will survive in the complete collapse of paper money. What is your take? I think, yeah, that's a lot of the thesis behind gold ownership and positioning it. Um, Another question from Hamid: Was Warren Buffett wrong not to invest in in gold? Fun question. I don't, I mean, I don't think so. What I love about Warren Buffett and investors like him or Ryan is that they take specific thesis, they stick to it, they're very consistent, they've done phenomenally well. There are many ways to do well. It's just really a matter of also understanding the sector well. Warren Buffett was probably more wrong of not investing in, you could say, technology. He missed out on a lot of potential investments, but the area where he mastered, which is, heavy concentrated bets in Amex and Coca-Cola and all these value stocks, he's done phenomenally. So there isn't one path to success. But I'll let you, Ryan, give your take on Goldtech, as he's been, one of the main critics that probably makes your life a bit harder when talking when talking about gold.
No, there's no right and wrong. I mean, Warren Buffett has had a phenomenal trading and investing career. His method is very long term, consistent, systematic, and very concentrated. And you know what? It paid off.
Yeah,
Uh, so he's taken the US risk, the US exceptionalism. He bet on it. He went long US exceptionalism. I wouldn't have done it. He's an American. He's born and raised in the US, in the heart of the US.
yeah,
I'm not. So yeah, so he has made that bet. There's no right or wrong. He's a multi-billionaire. He's now retired. As soon as he retired, Berkshire Hathaway just started dropping in price, completely underperformed. So this tells you something. He was a very good manager, investor, etc. So yeah, kudos to him. I wouldn't say he was wrong because he did well.
yeah. But I appreciate the question, also the answer, but that's exactly why I was really excited on this amazing webinar and content, Ryan, just because I can't imagine what it's like to have that conviction early 2000s and then again after the crash and to see it through after so long. It's really an incredible conviction that you have, and congratulations. And
Thank you.
really want to thank you for this. Probably one of the best, most insightful webinars.
Thank you.
Covers it from a very balanced perspective. So really, really appreciate it. I think everyone gained a ton of value, and we'll share this with many others. So thanks again, and
Thank you for having me.
thank you, Ryan, and thanks for
Thank you. Thank you. Thank you.
take care. Bye bye.
Thank you. Have a good evening.
You too.